Welcome to enrichminds.com and to our session on Bitcoins. And what happened?
It's okay. I went to the very top end, so I started over and somehow I was looking at it. Okay, give 10 seconds.
Did you tell the other two though?
Started 45.
Welcome to enrichminds.com and to our session on Bitcoins and the underlying technology and innovation behind it called blockchain. In this session today, we shall discuss what a blockchain is and how it is implemented in Bitcoins. In the first part of this session, we shall study blockchain. Let's start with a short video clip explaining what blockchain is, courtesy of Napkin Finance. Let's understand what blockchain is. A blockchain is a distributed database or ledger that is shared among the nodes of a computer network. As a database, a blockchain stores information electronically in digital format. Blockchains are best known for their crucial role in cryptocurrency systems such as Bitcoin and for maintaining a secure and decentralized record of transactions. The innovation with the blockchain is that it guarantees the fidelity and security of a record of data and generates trust without the need for a trusted third party. One key difference between a typical database and a blockchain is how the data is structured. A blockchain collects information together in groups known as blocks that hold sets of information. Blocks have certain storage capacities and, when filled, are closed and linked to the previously filled block, forming a chain of data known as the blockchain. All new information that follows that freshly added block is compiled into a newly formed block that will then also be added to the chain once filled. A database usually structures its data into tables, whereas a blockchain, as its name implies, structures its data into chunks or blocks that are strung together. This data structure inherently makes an irreversible timeline of data when implemented in a decentralized nature. When a block is filled, it is set in stone and becomes a part of this timeline. Each block in the chain is given an exact timestamp when it is added to the chain. The goal of blockchain is to allow digital information to be recorded and distributed, but not edited. In this way, a blockchain is the foundation for immutable ledgers, or records of transactions that cannot be altered, deleted, or destroyed. This is why blockchains are also known as a distributed ledger technology, or DLT. In normal databases, like in Excel, you can go and erase old data and add new data. In blockchain, new data is added to the one prior to it in a series of numbers. What one ends up with is an unchangeable history of information. How do you add a new block to the chain? Step number 1, transaction. To start the block, some type of transaction must occur. For example, someone sends money to another person. Step number 2, verification. A network of computers confirms that the details of the transaction are correct. In the example of sending money, the computers verify the individuals involved, the amount, and when the transaction occurred. Step number 3, storage. The verified transaction is stored in a block, which might contain hundreds of other transactions. Step number 4, hash. That block is given an identifying code or hash. The new hash is created from the previous block's hash, but is its own unique series of numbers and letters. The connection from one block to the next keeps the blocks from being changed or edited, because changing one block would require changing hashes for every single block in the chain. The big advantages of blockchain are, first, trust. If a record can't be edited, for example, the bank can't accidentally erase a 0 from the end of your account, then you can trust it. Second, no middleman. Because the blockchain is spread over a wide network, there is no central person or group controlling the flow of information or money. Third, security. Because the information is encrypted and decentralized, it is essentially impossible for one person or organized group of people to hack it. Blockchain as a technology was first outlined and defined in 1991 by Stuart Haber and Scott Stornetta, two researchers who wanted to implement a system where document timestamps could not be tampered with. But it was really with the launch of Bitcoins in 2009 that blockchain as a technology was widely adopted and became famous. Now that we understand blockchain better, let's now study Bitcoins and how blockchain has made this new world of cryptocurrencies even possible. Launched in 2009, Bitcoin is the world's largest cryptocurrency by market capitalization. Unlike fiat currency, Bitcoin is created, distributed, traded, and stored using a decentralized ledger system known as a blockchain. Bitcoin's history as a store of value has been turbulent. It has gone through several boom and bust cycles over its relatively short lifespan. As the earliest virtual currency to meet widespread popularity and success, Bitcoin has inspired a host of other cryptocurrencies in its wake. So, how can one get Bitcoins? First, purchase. You can buy Bitcoin with another currency, such as the US dollar, just like you can trade dollars for euros or other traditional currencies. Second, receive. You can trade goods or services to receive Bitcoins. Third, mine. You can become a Bitcoin miner, which is someone who devotes a large amount of computing power to solving complex math problems and who gets rewarded in Bitcoin. If you don't want to mine Bitcoin, it can be purchased using a cryptocurrency exchange. You can buy Bitcoins on exchanges like Coinbase, Binance, or Huobi Global. There are many such popular Bitcoin exchanges. Most people will not be able to purchase an entire Bitcoin because of its price, but you can buy portions of Bitcoin on these exchanges in fiat currency like US dollars. After you open an account in an exchange, you have to fund that account with your funds using fiat currencies like US dollars. You can fund your account using your bank account, credit card, or debit card. As in any other exchange, you can then buy Bitcoins just like buying any share of a company. You can sell Bitcoins just as easily. Some people own Bitcoin mainly as an investment in the hope it will keep climbing higher and higher in price over time. Other people use it to make actual day-to-day purchases. But before you open up a digital wallet, consider these trade-offs. The advantages of Bitcoins are that it can be used anywhere in the world. You can use Bitcoins anonymously with very little tracing. You do not need any debit or credit card for your purchase. You can pretty much use your Bitcoins with no transaction fees. And there is no limit to your spending power as long as you hold Bitcoins in your wallet. However, on the negative side, you have to be aware that not all merchants or shops accept Bitcoins yet. Your purchases are not insured. The value of Bitcoins is highly volatile, and your wallet may not be 100% secure. Over the last year or so, the price of one Bitcoin has reached a high of $68,789 US dollars and a low of $17,708 US dollars over the last 52 weeks. The price of Bitcoin has been highly volatile, as can be seen in the chart here. Let's look at the risks of investing in Bitcoins. First, regulatory risk. The lack of uniform regulations around Bitcoin and other virtual currencies raises questions over their longevity, liquidity, and acceptability, especially in many other countries. Second, security risk. Most individuals who own and use Bitcoin have not acquired their tokens through mining operations. Rather, they buy and sell Bitcoin and other digital currencies on popular online cryptocurrency exchanges. Bitcoin exchanges are entirely digital and, as with any virtual system, are at risk from hackers, malware, and operational glitches. Third, insurance risk. Bitcoin and cryptocurrencies are not insured through the Securities Investor Protection Corporation, or SIPC, or the Federal Deposit Insurance Corporation, or FDIC. Some exchanges provide insurance through third parties. In 2019, the trading platform SFOX announced it would be able to offer Bitcoin investors with FDIC insurance, but only for the portion of transactions involving cash. Fourth, fraud risk. Even with the security measures inherent within a blockchain, there are still opportunities for fraudulent activity. For instance, in July 2013, the SEC brought legal action against an operator of a Bitcoin-related Ponzi scheme. Fifth, market risk. As with any investment, Bitcoin values can fluctuate. Indeed, the value of the currency has seen wild swings in price over its short existence. Subject to high volume buying and selling on exchanges, it is highly volatile. The price of Bitcoin fell by 61% in a single day in 2013, while the one-day price drop record in 2014 was as large as 80%. Hindsight is always 20/20. 2010. A man in Florida paid for 2 pizzas with 10,000 Bitcoins, the first physical purchase using Bitcoins. So, 2 pizzas equaled 10,000 Bitcoins. In 2022, 10,000 Bitcoins equaled about 200 million US dollars approximately. Those 2 pizzas were worth about $100 million each. Let's now watch a short video on Bitcoins courtesy of Investopedia.
Bitcoin is the first decentralized digital currency. It is also sometimes referred to as a virtual currency or a cryptocurrency. Bitcoins are held in a digital wallet and can be sent over the internet. Bitcoin transactions are authorized using a digital signature. The transactions are verified, usually within minutes, by a network of miners. Once verified, the transaction is permanently stored on a public ledger, known as the blockchain. Fees for Bitcoin transactions are relatively low compared to traditional ways of commercially transferring money over the internet. Bitcoin was started in 2009. It follows the ideas set out in a white paper released under the name Satoshi Nakamoto. There are no physical Bitcoins, only balances associated with public addresses. The balance of each address can be viewed on the public blockchain, which keeps track of all transactions. Each address has an associated private key, which is used to authorize transactions. The key should be known only to the owner. Bitcoin can be bought on exchanges. It is legal in the United States and most countries. However, Bitcoin regulation is not yet well formed. It is accepted as payment by some local merchants and online retailers. New Bitcoins are released through a process called mining. Anyone can participate in mining with a computer using free open source software. The interval at which coins are released is kept constant by the network, and because of this, the more miners that participate, the harder it is to mine. The amount of coins being released at each interval is decreased by half around every 4 years. The total amount of coins released will approach 21 million.
In summary then, here are 3 main takeaways. First, blockchain technology powers all cryptocurrencies. There are lots of applications of this innovative technology, and we are just at the cusp of exploring its new applications. Second, Bitcoin was a pioneer in cryptocurrencies. And third, one must approach Bitcoin or any other cryptocurrency with caution and skepticism, as it is not yet mainstream in terms of market acceptability as a currency, and its value is highly volatile as an asset. Thank you for your time, and until next time then, stay enriched and strong.